It was an unknown author who said, "Goodbye tension, hello pension." In this video, we're going to calculate pension benefits using various formulas. We're also going to calculate pension benefits during and after vesting periods, all to be able to answer the question, what is deferred compensation? Let's make sure you're ready by taking a look at warm-up number 2, where we write the linear function f of x that describes the relationship in each set of ordered pairs. I can see in A that there is a constant changing of values of x's of a positive 2 and a positive changing of 4 in the y values, meaning my slope would be 4 over 2, or 4. Now I'm going to write a linear function where y is mx plus b, m is 2, and b is when x is 0. Conveniently, they gave it to us as 8. Looking at the second one, I can see a constant changing value for x of 2 and a constant changing value of y of 6, giving me a slope of 3. So looking at y is mx plus b, using -1 as the y, +1 as the x, the m is 3. What is b? 1 times 3 is 3. Subtract it from the other side, so -4 is b. This means our y is mx plus b is y is 3x minus 4. Now let's take a look at a problem that you will definitely be able to do by the end of this lesson, and that is Anna's employer offers a pension plan that calculates the annual pension as a product of the final 3 years average salary, the number of years of service, and 2% multiplier. Her employer uses a graded 6-year vesting formula as shown. After 5 years, Anna decides to leave her job. Her average salary was $50,000. How much pension will she receive? Well, they told us that it was the average salary times the years that she worked there times that percentage multiplier. So if her average salary was $50,000 and we multiply it by the 5 years that she worked there and we multiplied it by the 2% or 0.02, we get 5,000. At 5 years, she gets 80%. So 80% or multiplying by 0.8, we get $4,000. Anna will receive an annual pension of $4,000. Money given or received at a later date, usually in return for services that have been given or received at the present time, is deferred compensation. A pension is a deferred compensation plan. A pension is income given to an employee after retirement at the discretion of the employer. Employers are not required to fund pension plans for employees. The compensation from the plan is usually tax deferred for employees, and the contributions that the employer makes for the employee are tax deductible. There are 2 types of traditional occupational pension plans: defined benefits and defined contribution plans, such as 401k plans. In a defined benefit plan, the employee pension benefits are calculated based on a formula that may involve the average salary before retirement, the age of the employee at retirement, and the length of employment, and some predetermined percentage multiplier. An employer makes all decisions on the investment options for the money in the plan. There is no individual account for any one specified employee, but a pooled fund upon which benefits are drawn upon retirement. In almost every defined benefit plan, an employee must participate in the plan for a certain number of years before being vested or having the right to it. There are 2 types of vesting. In cliff vesting, an employee is entitled to the pension after having participated in the plan for a fixed number of years. Suppose that you are in a plan with a 5-year cliff vesting formula. If you work for the employer for the last 5 years, you will be entitled to receive a pension even if you leave the company. If you leave before 5 years, you will not be entitled to a pension. Graded vesting does not set an all or nothing time period. The employee gets a certain percentage of the pension after each set number of years has passed. For example, you might own only 20% of your pension after the first 3 years of employment, and then for every year you work afterwards, your ownership increases by 5% to a maximum of 100%. When it is time for your pension benefit paid out to you, usually upon retirement, there are some common options that are available. A single life annuity offers the retired employee a fixed monthly amount until death, when all benefits stop. A qualified joint and survivor annuity offers the retiree a smaller monthly payment, but upon death, the spouse will continue to receive reduced payments until his or her death. A retiree can sometimes choose to take a lump sum payment in which all of the money owed to you is given in a single payment and no further payments are made to either you or your beneficiaries. There are different formulas that are used to calculate a pension. Flat benefit formulas pay a fixed flat monthly pension based solely on the years that the retiree has worked for the company. Career average formula pays a pension that is based on a fixed percentage of the average earnings of all of the years of the retiree has worked for the employer. Final average formula pays a pension that is based on a fixed percentage of the average earnings of the last several years, often 3 to 5, of work with the employer. Most defined benefit plans are insured under the federal pension insurance program known as the Pension Benefit Guaranteed Corporation. The PBGC is a federal government agency that insures most defined benefits pension plans. It was created under the Employee Retirement Income Security Act, or ERSA, in 1974 to protect the pension benefits for retirees. In 2006, the Pension Protection Act was passed, which amended ERSA and offered legislation to strengthen and protect many types of pensions. Some benefit plans are fixed throughout the life of the retiree, while others can reflect the annual cost of living adjustment, or COLA. The cost of living adjustment is a small increase in a retiree's benefits that are based on the Consumer Price Index, or CPI, or Cost of Living Index. The CPI is an indicator of inflation that measures the change of the total cost of a specific list of service and product. Let's calculate pension benefits using various formulas. To do this, let's look at Roberto, who worked at the Surgical Tool Corporation for 20 years. His employer offers a pension benefit package with a flat benefit formula using flat amount of $40 for each year of service to calculate his monthly pension. How much will Roberto's monthly pension benefit be? Roberto's monthly pension benefit is the number of years of service for the company times the flat rate amount of $40. He worked there for 20 years times the $40 per year is $800. So Roberto will receive a monthly pension of $800 from Surgical Tools Corporation upon retirement. Let's check your understanding and look at Mandy, who has worked for the same company as Roberto for the last X years. She's considering working for Y more years, at which time the flat benefit that Surgical Tools offers will be Z dollars for each year of service. Write an algebraic expression that represents Mandy's monthly pension benefit. She has been working there for X years and wants to work Y years more, which means we're going to add this. The total number of years will be X plus Y, and Z is the dollars that will be paid every single year, so we get X plus Y equals Z, or if you wanted to distribute it, XZ plus YZ. Well, after 1 year of retirement, Roberto's employer, from the first problem, offers a 2.21% cost of living adjustment to his monthly pension benefit. The next year, the employer offers 2.35% COLA. Determine Roberto's new monthly pension benefit. In the first problem, we learned that Roberto's monthly pension benefit was $800. Multiply the monthly pension benefit by the first cost of living, which was 2.21%, so 0.0221, and we get 17.68. Roberto's cost of living adjustment is $17.68. Add that to the $800, and his new monthly pension benefit after 1 year is $817.68. To calculate the latest monthly benefit with 2.35% COLA, multiply by 1.0235. That is the 2.35% increase, and 1 representing the fact that we're keeping that number and doing this in one step. So that his new benefit is $836.90 approximately. So Roberto's new monthly pension benefit is $836.90. Let's check our understanding of this by looking at Jackie's monthly pension benefit, which was originally D dollars. Each year for the past 5 years, she has received a 1% COLA. Write an exponential expression that represents Jackie's current monthly pension benefit. Well, we know that she makes D dollars, and for the first year, we could multiply that by 1.01. The second year, multiply that by 1.01, and the same for the third year, the same for the fourth year, and the same for the fifth year. Knowing that we could write all of this shorter as D times 1.01 to the fifth power. Well, Alex's employer offers an annual pension benefit calculated by multiplying 1.5% of his career average salary times the number of years employed. Alex has kept a list of his annual salaries in a spreadsheet as shown to the right. Add cells to the spreadsheet to calculate Alex's annual pension benefit. So let's take a look at the Excel spreadsheet. The first thing we want to do is calculate the average career salary. And we're going to do this by saying equals average, open parenthesis, and then we're going to highlight all of those cells. Close the parenthesis and hit enter. To figure out the average pension benefit, we're going to say equals, open parenthesis, D1 divide D1 times D2 divide 100 times D3, close the parenthesis and hit equals. Now his adjusted pension will be equals D4 plus, open parenthesis, D1 times D2 divide 100 times D3 times D5 divide 100, close parenthesis and hit enter. His annual pension benefit rounded to the nearest penny is $26,620.01. Let's check our understanding of this, and suppose Alex wants to determine his annual pension benefit after any cost of living adjustment. He labels cell C5 as COLA and cell C6 as adjusted pension. He then enters the COLA percentage into cell D5, writes a formula for cell D6, and what will yield the pension with the cost of living adjustment. Let's take a look at the Excel spreadsheet again. At adjusted pension, we're going to hit equals D4 plus, open parenthesis, D1 times D2 divide 100 times D3 times D5 divide 100, close parentheses, and hit equals. So we can see that his adjusted pension is $26,886.21. Now let's take a look at Brian and Marina, who are married, and each is planning on retiring after 30 years of employment. Marina worked for the entire 30 years at Lincoln Central Corporation. For the last 3 years, she's been making $110,000 per year. Brian has been making the same salary for the last 3 years at Lincoln Central, but has only been working there for 15 years. Prior to his current job, he worked for 15 years at a competitor and had a final average salary of $60,000. Both employers offered a defined benefit plan that calculated the annual pension as the product of the final 3-year average salary, the number of years of service, and 2% multiplier. Calculate and compare Marina and Brian's annual pension upon retirement from Lincoln Central. Marina's annual pension can be calculated as her 3-year average salary, which was $110,000, times her years of service, which is 30 years, times the percentage multiplier of 0.02, where she will get $66,000. Marina will receive an annual pension of $66,000, although Brian worked for a total of 30 years. He received 2 pensions, one for his first 15 years of service and one for his last 15 years of service. His annual pension benefit is the sum of these 2 pensions. So for job 1, he had $60,000 as his average salary times the 15 years of work at 2% or 0.02, giving him $18,000. The second job had an average salary of $110,000 for 15 years and 2%, giving him $33,000 there, meaning he had a total of $51,000. Although Brian and Marina worked the same number of years and ended their career at the same time and salary, because Brian averaged the salary for the first 15 years was lower, his annual pension benefit is about $15,000 less than Marina's. Let's check your understanding by seeing what would Brian's average salary have to have been for his first job so that the total pensions matches Marina's pension amount. Well, it stands to reason if he made $110,000 for the last 15 years as the average, if he made $110,000 for the first 15 years as the average, as unlikely as it might be, but since over a 15-year period, a person's salary usually increases, and it had only made it to $60,000. So we would want the first one to average at $110,000. Let's calculate pension benefits during and after a retirement period. Ann's employer offers a pension plan that calculates the annual pension as a product of the final 3-year average salary, the number of years of service, and a 2% multiplier. Her employer uses a graded 6-year vested formula as shown. After 5 years, Anna decides to leave her job. Her average salary was $50,000. How much pension would she receive? Anna's average salary was $50,000, and she worked there for 5 years. Their percentage multiplier is 2% or 0.02, giving us $5,000. Now, 80% of that is 0.8 multiplying the 5,000, giving us $4,000. So Anna will receive an annual pension of $4,000. Let's check our understanding and use the vesting schedule from the last example. And Ralph is leaving the company after 4 years. Ralph's salary was $38,500 a year. How much pension will Ralph receive? $38,500 times the 4 years he was there and their 2% multiplier gives us $3,080. But he was there for 4 years, which means 60% or times 0.6. So Ralph will receive $1,848.